All right, so I had to re-record this section because it's a little bit difficult to understand. But when companies issue bonds, they want to try to offer something that is competitive within the market. But they only get one opportunity to, number one, print the bond documents that are issued to the investors. And there may be a time lag between the printing date and the issue date. During this time lag, changing economic events can cause the bond's stated interest rate to differ than what is actually the market rate for a similar bond. So to see how you need to consider only the relationship between the stated interest rate on the bond and what the bond pays in cash and the market interest rate, you have to consider some different scenarios. So if the stated rate is the same as the market rate, which is this line here in the middle, then the investors will be willing to pay the face value to acquire the bond. This is like how you might pay a premium. I apologize, let me back up a moment. So sometimes when the market rate falls below the stated rate, it often will allow investors to realize that if they participate in this bond issuance at 6%, they are actually getting a little bit more because of the stated rate on the bond is 6%. They're getting a little bit more than what is expected if the market is currently at 4%. If the market is a rate of 8%, but the stated rate on the bond form certificate is still only 6%, then investors may say, well, we don't know about this. The stated rate's only 6%, but right now the market rate is 8%. I might be losing some money. So there's two situations here. So when the stated rate is more than the market rate, investors are willing to pay a little bit more on the bond stated value, or the value that the bond certificate is issued. In this case, it was $1,000. However, if the market rate is more than the stated rate, then they may not be so willing to pay so much, but they'll say, okay, we'll give you this much since we're still going to get the 6% rate, even though the market rate is 8%. So when they pay a little bit more, when the market is 4% and they are getting a stated rate of 6%, and they're paying a little bit more money, then it doesn't change the interest that they are going to receive, but it just it allows the bond issuer a little bit more flexibility on the bond issuance. And then the bond issuer would have to accept the amount that investors are willing to invest if the market is higher. So they will pay a little bit less, and the company will just have to consider that decrease, which is called a discount. The first one, where we talk about the investors are paying a little bit more, that's a premium. And we'll see where that comes into play when we get into the transactions. In reporting bonds, the total face value of a bond plus any related premium in the green scenario, or minus any related discount, which is the blue scenario, is reported in the liability section apart from the actual face value of the bond. The amount of the bond liability, after taking into account any premium or discount, is referred to the carrying value. So the carrying value, as we will see, could be more than the $100,000 rate face value of the bond, or the carrying value could be less, which is recognizing the discount that was offered for the bonds. So let's look at some numbers to see what could happen. So the bonds payable, as we said, is the stated rate on the bond certificate, which was $1,000 per issue. So 1,000, the bonds payable liability account is the same for each scenario. Now, don't take into consideration that these things happen at different times. This is what happens. Each scenario is each scenario can only happen one time. And that's at the beginning of a bond issuance. It could either be offered at a premium because the time between the printing of the bond certificates and the actual issuance, something could have happened to blow the market out of the water or to explode the market, and it's just declining badly or even a little bit. So, but despite how the market is running, the face value of the bonds is the bond payable and is the same for each scenario. The premium is the additional amount that investors paid to get involved in this bond issuance. So that's a positive here, positive 7,260. So the company actually took in 107,260. On the opposite end of the scenarios are the discounted bond. So you will see the 100,000 face value less the amount that the investors were not willing to pay. They said, okay, we'll give you some money towards it, but we're not giving you the whole 100,000. So the discount on the 100,000 is the 6624. Now these two amounts are not paid out. They don't go to the investors. It's not another number on the income statement per se. What happens is on your liabilities, you're going to have the 100,000 listed for both scenarios. And then either you're going to have the premium listed, which increases the carrying value of the bond issuance. So the carrying value in this example is 107,260. The carrying value when the issuance was at face value is always 100,000. And then the carrying value for bonds sold at a discount is less than the face value. So a bond issuance can only be one of these three scenarios. Now the percentages could be up or down, the stated rates could be different. You know, those numbers can change. But for the examples here, only one scenario occurs when the bonds are issued, not all three. So keep that in mind. What happens at the end is that the premium or the discount is another one of those items that we amortize. Remember, we talked about amortization along with depreciation, which is where we take an amount that's on the balance sheet and spread it across a certain period of time. And then somewhere it goes on the income statement. And in this case, it's added to the interest expense that's paid annually. So we're going to move on to some examples, and hopefully this will become a little bit clearer for you. All right, class, this is chapter 10, the last chapter that we will go over in this class. So we are now talking about liabilities. Just a quick refresher, liabilities to a company are the things that the company owes. Various kinds of liabilities exist. So you have your short-term liabilities, which includes your accounts payable. Those are things like your electric bill, your telephone bill. Also, current liabilities, less than 1 year that are due, could also include your payroll taxes. Generally speaking, most companies, even the smaller ones, when they use QuickBooks, they will pay their taxes every month. And that can be done through the accounting system. If bigger accounting systems have payroll modules, they are automatic as well. And we just learned that even the small companies will have to start doing their filings electronically. So everything is going through the web, including payments. So you're going to see on your balance sheet, you may see payroll tax liabilities. Other kinds of liabilities are your short-term notes payable, like the promises to pay. Those are short-term or current liabilities as well. Long-term liabilities, the ones that are due over a year, are like your extended notes payable. For example, when you buy equipment on a 5-year note, those are your long-term liabilities. You may have a mortgage that is a long-term liability. You also have other kinds of liabilities. For example, in a partnership, shareholders may the company may owe the shareholder some money. The shareholder perhaps did not want to call all of the money that they've invested in the business. They wanted to get some of it paid back, so they may have put some in a liability where the company is going to pay it back, and then they'll put some in their capital account, which sits there until they decide as a company to either make distributions or whatever that might be. There's also different kinds of funding, and I believe this chapter is going to go into that. So the role in financing a business or within the business is to buy the goods and services on credit, obtain short-term loans for possibly some short-term cash needs, and then they could get long-term debt as well. Current liabilities are short-term obligations that will be paid within the current assets within the company's current operating cycle, or usually within 1 year of the balance sheet date, whichever is longer. The role of liabilities can also, as I mentioned in the summary, is your accounts payable, your accrued liabilities. That's one I didn't mention. Remember, your accrued liabilities are things like you have created some expenses, but you have not gotten a bill for yet, and you wanted to make sure that those expenses go in the month that they were used. For example, your rent expense or your electricity bill. You don't get your electricity until the middle of the month, but in most cases you can find out what you owe for that month so that you can book it on the last day of the month and have it in the month that you actually used the electricity. So those are your current liabilities. Your notes payable, again, those could be long, or most generally they are long-term debts. Sometimes a note payable can be short-term. It depends on the company, it depends on the chart of accounts. So there's the current portion of long-term debt, which is the payments and or interest that are due within the year. The long-term debt are payments that are due after the year. So at the end of the year or at the beginning of the year, companies are going to move some of the payments from their long-term debt to their note payable in order to recognize the short term or the amount of money that would be needed to pay that in the short term. That's very important for bankers and other people who lend to companies. It's very important to know what amount of money would need to come out in the first year of this note. And then you have some other liabilities, and then your total liabilities. So the initial amount of the liability is cash equivalents. So you're recording the initial amount of the liability. The company then records each liability at its cash equivalent, which is the amount of cash a creditor would accept to settle the liability immediately after a transaction or event. The second factor is how to handle any additional amounts owed to the creditor. The company increases liabilities whenever there's additional obligations that arise. For example, your water bill, your landscaping bill, Some of the liabilities incur interest. Your accounts payable, like your bills, your electricity, those don't come, you don't have to pay interest on those. You pay late fees if you pay them late, but that's not considered interest. The third, handling of payments or services provided to the creditor. And then the company decreases liabilities whenever the companies make payments or provides the services. For example, if you have accrued liabilities, then those are written off as you pay them. I said written off, but they are taken off the books as you pay them. So accounts payable. We know that the normal balances on accounts payable are your credits, and which increases the account. And when accounts payable accounts are paid, a check is sent or money is sent via a wire, payments are made online, those decrease your account payable. In other words, they are debited. Your accrued liabilities, again, liabilities that have been incurred but not yet paid. Payroll liabilities, payroll deductions, for example, health insurance. Many companies offer health insurance, even your smaller ones now, because of the mandate for even smaller companies to have health care. Most of the time, the employees, they pay into the health care, but not in total. So whatever is withheld from their paycheck goes into a deduction or a payroll liability account in order to pay the health care when it's due. Then, when everyone gets their paychecks, there are also payroll taxes. So there could be several different kinds of liabilities that are recorded every time somebody gets paid. You have your 401k disbursements that need to be paid. You have your health care disbursements that need to be paid. These things are things taken out or withheld from an employee's paycheck. If employees have taken loans out on their 401k, there could be loan payments through a payroll deduction. There also could be different kinds of insurance, eye insurance, long-term health care insurance, long-term disability insurance, short-term disability insurance. All of these things would be liabilities until they're paid to the company managing those resources. So it would look something like this. You have your gross earnings, then you have your payroll deductions. So you have your taxes. This is your federal tax, your FICA tax, which is your Social Security and Medicare. And then there's other deductions. Perhaps this might be the deduction for health insurance. So you have a total payroll deduction of $116.80. Then the net pay is $483.20. So the net pay also may be, usually for maybe a day or two, in a liability account called direct deposit payable. So that net pay is going to sit in a direct deposit payable until the cash actually transfers to the employee. The items in blue, those get recorded in the individual accounts. Sometimes payroll taxes are all lumped into one payroll liability account. Sometimes, like I have some, like myself, I like to see them separate. I like to see federal and then state separate. And then, of course, your other healthcare and things, I would keep those separate as well, just to keep it nice and clean. When you're reconciling accounts that have various different things going through it, can be a little bit tough. But anyway, so we'll talk about the journal transaction in a moment, but the amount of the gross pay or gross wages is $600. Then you reduce the cash part of it to $483 with the deductions. Another thing that can come out, which at my job, we can have charitable deductions come out. Now, the thing about charitable deductions when they're on a payroll check, and this could be just useful for your own information, is that the charities really may not know where their donations are coming from. So they may not be included on a statement. So you're going to need to hang on to your payroll check to show as proof of your charitable deduction. All right, so this is what it looks like on the balance sheet, or I should say the journal. So you have your gross pay of $600, your federal income taxes, Social Security, and other withholdings, and then you have your net pay. So this is just your pay stub broken down a little bit differently. You have your salaries and your wage expense here, your current liabilities, and then your cash payment here. So here's our first example. Adam Palmer earned gross pay of $600, which is in our example. The current payroll period in General Mills withheld $60.90 in federal tax, $45.90 for FICA, and $10 for the charitable contribution, resulting in the net pay of $483.20. So let's assume General Mills has 1,000 workers just like Adam. So this is going to involve a little bit of multiplication. So because there's 1,000 workers that are getting paid exactly the same way, exactly the same deductions, you're just going to multiply the numbers by 1,000. So the cash coming out of the bank is $483,200. Each of your liabilities goes in their particular liability account multiplied by 1,000. And then your salaries and wages expense is your wages of 600 times 1,000. So this is your journal entry. Again, remember your wages is the entire 600,000. It's not just the 483.20, it's the entire 600,000. And then the wages less all of the deductions less the cash payment does equal the 600,000. So don't let that confuse you whenever you're doing your homework. The 600,000 is going to be the total wage, and then all of the liabilities, including the cash payment, are your credits. So we're accruing payroll. Accruing payroll means that employees have worked a certain part of a period in 1 month, or all of it in 1 month, but does not get paid until the following month. So in this example, General Mills was required to contribute $45,900 for FICA and an additional $47.50 for federal and state unemployment taxes. So this FICA payable is the $45,900, and the unemployment tax is the $47.50. The payroll tax expense are these two items added together. So another part of accruing expenses is not only could the payroll or the wages be accrued, but in this example, it's derived from our previous example. So when the $600,000 in payroll and its allocated liabilities were dispersed, this is also another example where the company owes its part of the liabilities. Most of you already know, you've probably already gotten a paycheck. You have your portion of the liability to the Social Security Administration, and the company pays its share. You pay 7.65%, the company pays 7.65%. So together, it's a little over 15% that gets paid into your Social Security account. Unemployment taxes do not come into play until the end of the year, but during the year is when they are accrued. So the unemployment tax for the current payroll period was $47.50. So these two amounts go into the liabilities, and then you have your payroll tax expense of the additional $50,650. So your expense, $50,650, is equals the $45,900 to Social Security and the $47.50 to unemployment. Income taxes. These are the taxes that get accrued at the end of a period after you've done all of the adjusting entries and come up with the net income or loss at the end of a period. So the taxable income is multiplied by the federal tax rate, whatever that is. It should be given in your problems. The taxable income is then multiplied by this rate of 21% for corporations. So let's assume General Mills calculated taxable income to be $1 million. And so with the rate being 21%, you're taking that million times 21% to come up with the $210,000. This is another accrual because you're not paying it in the period that these expenses were incurred. You're paying it at the end of the year. But during the year, in order to have your expenses match the period in which they were created, in other words, the employees worked in June and they got paid. So June has the regular payroll, the wages, and all of the employees' deductions, but it also has the company's deductions. Okay, and then it also has the company's net income and calculated by the percentage rate for the income taxes. So here it is on the T account. You have your liabilities increasing $210,000 and your income tax expense, which is your debit, for $210,000. Income tax expense, $210,000, and your liability, $210,000. So that's another form of accrued expenses. All right, so here we are talking about our notes payable. There are 4 key events that occur with every note payable. The first thing is you have to establish the note. It's between 2 parties. 2 parties have to agree to an exchange. The second part of a note payable is the interest being accrued until it's paid. So recording the interest paid and recording the principal paid is part of a note payable payment. So in this example, you might remember this. This might look familiar. We had an example a few chapters ago where we had a note payable that it appears that this is a 12-month note. There are 2 months in 2021 and there are 10 months in 2022. So this was a note where there were no payments due until it matured at October 31st of 2022. However, from the date that the company received that money to the date of the maturity, interest accrues. And since taxes and reporting and everything else gets done at the end, generally speaking, at the end of a fiscal year or a calendar year, they have to accrue that 2 months of interest in 2021. So the note was written on November 1st. It was established at that time. 2 months have gone by. Now the company owes 2 months worth of interest. So here this is saying, number 1, the note is established. Number 2, you're recording the interest that's accrued using a year-end journal entry. Number 3, you are recording the interest paid at October 31st when the entire interest is paid, and then you're also recording the principal paid. So at October 31st, if it's a good loan, the company has the money to do so. They pay the loan off as well as the interest that has accrued for the whole year. Assume that on November 1st, General Mills borrowed $100,000 on a one-year note that required it to pay 6% interest, and both were due on October 31st, 2022. So we got the cash, so our cash increased. We exchanged that cash for a note. We gave the note to the bank, and we signed it, and we understand that next year, after a year, we owe $100,000 plus the 6% interest. But notice here, on the first transaction in a note payable, you're only recording the cash received and the payable. Debiting cash and crediting note payable, both accounts are increasing. Now, part 2, calculating the interest for 2 months. We have the interest, which is $1,000. I'm sorry. Yes, interest is $1,000 per month, and the way we determine that, so we take the $100,000 times the 6% to get the $6,000 times 2/12, meaning this 2 represents the 2 months of interest that we need to accrue at the end of the year. So the interest payable is $1,000. $6,000 times 2/12 or 1/10 is $6,000 for the entire year, so that's $500 per month. Not $1,000 as I said a moment ago. It's a $500 per month. So your total interest payable is $1,000. Your interest expense is $1,000. Your interest expense is a debit. Your interest payable or your liability is a credit. Both accounts again are increasing. Now we need to record that interest that we paid on October 31st, and it's going to be the entire $6,000. We're going to take $6,000 out of our cash, pay down the interest payable, and our interest expense, though, only is $5,000 because remember, $1,000 of it was recorded in 2021. So we are removing this payable. We're adding additional $5,000 for the expense. Here we have the interest expense of $5,000, the interest payable of $1,000. That's making this interest payable account, if it's the only note, to a 0, and then our cash decreases $6,000. And then we need to record the principal because we're paying the principal as well as the interest. Our cash is $100,000. The note payable goes down to 0. Our note payable decreases and our cash decreases. All right. Additional current liabilities can include our sales taxes. If we sell items or services that are taxable, this is another form of a liability that we need to accrue that we've collected. Usually we're collecting sales taxes as we go, and as we go, usually on a daily basis with automated systems, your sales tax payable account is going up every day until it's paid. States usually ask for payments monthly. Sometimes they can go annually if, for example, a company, like I have one company that sells items on the internet. So when he sells items on the internet, he rarely has any sales in the county in South Carolina where he does business. So after I take his whole sales for the month, I determine where the sales taxes were created. The sales taxes are created based on where the item is shipped. So most of the time, he has several different states that have payroll taxes that are due to him. Now, we won't go into any of the sales taxes because it can get quite complicated. So we'll go over that should the need arise. But in the meantime, what you want to think about is that your sales taxes collected do not get recorded with your sales. Sales tax is not a sale. Sales tax is the tax that is owed to the government. Okay? At that time of sale, that is when the liability is incurred. And we put it into a deferred revenue. So cash received in advance of providing services creates a liability of services due the customer. What this is saying that when we receive cash, but we have not delivered yet, we have not done the service yet, we have not delivered the products yet, but we've got the cash, we owe that customer that money until we have provided or the exchange takes place. You remember way back in lecture 1, we talked about the exchange. An exchange needs to take place for a transaction to happen. So when we have a one-sided don't want to get you confused, but in this case, we've only received cash and a promise to send or a promise to do the service. All right. So this is the deferred revenue. We're going to defer the revenue until we actually earn it. Best Buy sells a television for $1,000 cash plus 5% sales tax. Simply stated, the 1,000 times the 5%. Most of you know how sales tax is calculated. If you buy a burger for $1 and there's a 9% sales tax, you pay $1.09. $1 is the sale for McDonald's. 9 cents is the liability to the county or state. So the transaction is going to look like this. You're going to receive the entire amount, the $1,050, but you're going to record the $50 as a tax payable and the sales revenue as $1,000. Your cash is increased. Your sales tax payable, $50, and your sales revenue is $1,000. And this is because the customer goes in, they take the TV, they exchange it for the cash, they take the TV out, so the TV has been delivered. There's no deferred revenue here. In January, Live Nation Entertainment, the owner of Ticketmaster, received $800,000 cash for advanced ticket sales for 2 concerts to be held May 12th and 15th of the same year. So think about this. In January, they've received $800,000 in cash. Can they record the revenue? No, because they have not delivered the service that comes with that cash. So we are going to put it in our deferred revenue. Our cash increases $800,000. Our deferred revenue increases $800,000, which is a liability. Cash is increased, our liability is increased. Does this impact the income statement? None whatsoever. All right. So May comes around. The May 12th concert is held. Live Nation can recognize 1/2 of the deferred revenue as earned now, as they have fulfilled part of the liability. So the deferred revenue is going to decrease $400,000, and the service revenue is going to increase $400,000. Okay. Then when the second date comes around, the second concert, they are going to recognize the revenue again, the remaining revenue of $400,000, and then the remaining sales of $400,000. The current portion of long-term debt. Again, this means that the company has signed a long-term note, for example, a 5-year note. But on the balance sheet, we have 2 sections, remember. We have a current liability and a long-term liability. The current portion of the liabilities is recorded separate from the rest of the long-term debt. because companies want to know, okay, if this company goes out of business today, what is their the current ratio, right? We talked about that where we compare the current assets with the current liabilities. If that part of the current liabilities wasn't taken out of the long term and put in the current term, you have some things being the current debt is understated and your long-term debt is overstated. So it's very important to make sure that any debts that are due within the next year are recorded in the right place. So this is a bond liability. So long-term liabilities include your long-term notes payable, your deferred income taxes, and your bonds payable. Bonds are financial instruments that outline the future payments of that a company promises to pay in exchange for receiving a sum of money now. So in other words, the company doesn't want to create any debt. The bonds are financial instruments, not necessarily a debt per se as we're used to seeing, because the interest is not something that is guaranteed in some cases. So that's why it's kept separate from your long-term notes and your income taxes and other liabilities. So the bonds come with a certificate with a maturity date, a face value, and a stated interest rate. This means that at the maturity date, the company will repay $1,000. This one, the face value is $1,000. For each bond in the years prior to the repayment, the company will make periodic interest payments. So the 6% is the stated interest rate, and then this series of bonds is due to be paid on December 31st of 2024, which is the maturity date. Many bonds require interest payments every 6 months, that is semi-annually. So each interest payment is computed by multiplying the face value of the bond, in this case $1,000, times the stated interest rate, which for this year is 6%. Bonds may be priced at amounts above or below their face value. Also, a bond's price does not affect the amount of each interest payment. For example, a 6% bond with a face value of $1,000 will always pay interest of $60 cash each year. What that means is 1,000 times 6% is $60. And that is 1,000 times 6% times 12 over 12, or 1. Investors in the market establish the issue price. So the bond issue price is the amount that investors are willing to pay on the issue date in exchange for the cash payments that the company promises to make over the life of the bond. And if you're a little bit confused, join the crowd. Bonds and these kinds of transactions are fairly complicated, and it just takes some an extra thinking, extra homework, extra practice in order to really get a handle on these transactions. So again, the price of the bond is whatever the investors are willing to pay. When we see face value, that does not mean that that's how much money the investor provided. The face value is just something that gives the company a stated rate of interest that can be calculated. At the total face value, which is 100 times 1,000. So the way that's recorded is your cash increases. You are receiving cash from your investors, and then your bonds payable go into this long-term liability account. Cash, and then your bonds payable. And when I say long-term, we're assuming that the bond is going to be in existence for more than a year. And I believe that's the case for most bonds. They are normally a long-term solution to generate some cash. Here's another example that General Mills issues 100 of its $1,000 bonds at a price of 107.26%. So this is 100. This is an additional 7.26% of the face value. So the company will receive the total, as we saw in the example, $107,260. So the interest, the premium, is that 7.26% of the face value. Look at here though. The bonds payable is kept separate. The premium on that payable is kept separate from the total. So you have your total cash that you can just lump into one, but when it's recorded on the balance sheet, your payable is recorded at one amount and your premium is recorded at another amount. And you'll see why in a little bit. Cash is increased, bonds payable is increased, and your premium on the bonds payable is increased. General Mills receives the 93,376, and we talked about this. This is going to be the discount. So because you have some of these people that say, we'll go ahead and get involved in the bond issue, but we're not going to pay full price. So the 100,000 less the 93,376 that they received is the 6,624. The 624 is the discount on the interest. So you receive the cash, which is 100,000 less the discount of 6624. Notice here though, your cash increases. The discount is a debit entry because it's decreasing the value of the bond payable. So keep that in mind. When it's a discount, you're decreasing the value of the 100,000 to the 93,376. So that's a debit entry. So General Mills issues bonds on January 1st, 2021 at their total face value of 100,000. The bonds have an annual stated interest rate of 6% due on December of each year. So General Mills will need to accrue an expense and liability for interest at the end of each accounting period or at the end of the month. The end of the first accounting period is January 31st, 2021. So this company is on a monthly basis. So 100,000 times 6% times 1/12 or 1 month. 1 over 12 is 1 month. 2 over 12 is 2 months. So we are recording just for January. We're recording $500. The interest payable is $500 and the interest expense is $500. Okay. This is going to happen each month, every month in 2021. Interest on bonds issued at a premium. So the carrying value is $107,000. That's how much cash we received. The face value is $100,000. The cash proceeds less the face value is the premium. The $7,260 is the premium on the bond. the interest expense less the cash interest paid. So you have the interest expense equals the cash interest paid less the premium amortization. That's a mouthful. Again, we're getting a little bit more complicated, but you'll be able to understand this as we go if you just study hard, look at the problems, think about what's happening. So the issuance of this bond isn't exactly free money. So what that means is the people who have paid this premium, they're going to this, for accounting purposes, we match the reduced borrowing cost to the periods in which the bond remains unpaid. This process, called bond amortization, makes the interest expense smaller than the actual interest payment at the same time, causes the balance in the premium of bonds payable to decline each period. Because the premium amortization in each period reduces the company's cost of borrowing, the interest expense recorded each period will be less than the cash interest paid when bonds are issued at a premium. You'll see what that means in a moment. The interest expense each period is determined by subtracting the cash interest that the company is going to pay less the premium amortization. So the maturity date, as it reaches the maturity date, this 7260 is going to be amortized. So here we go. We have an issuance date. This is the discount. We have the cash proceeds is less than the face value, so that's why we call it a discount. In this case, the face value less the cash proceeds is the discount. We have the interest expense is greater than the cash interest paid, and the interest expense is the cash interest paid plus the discount amortization. So the amount of the discount is equal to the total face value less the proceeds from the issuance. The amount of the discount at the date of issuance in this example was $66.24. So the $66.24 is, as we noted, is in a discount account. This $66.24 is then amortized until the carrying value is equal to the face value. All right, so General Mills bonds were retired with a payment equal to their $100,000 face value. But let's analyze the transaction. So we're going to pay out the $100,000, and we are going to decrease the bond payable because we're settling it. So we record bonds payable decreasing $100,000 and our cash decreasing $100,000. The early retirement of bonds has three financial effects on the company. Number one, they have to pay cash. So they have to make sure that their cash flow is up to speed and can handle retiring a bond early. It eliminates the bond liability. So that means when the bond liability is gone, there's no more interest to be paid. However, there could be a gain or a loss depending on these premiums and discounts. So assume that 10 years ago, General Mills issued $100,000 of bonds at face value. If the company retired the bonds now at a bond price of $102, General Mills would have to pay $102,000 to retire the bonds. So the cash payment of $103,000 less the carrying value, the loss on this retirement is $3,000 because they have to pay out an additional $3,000. We have cash of 102. I believe this might be a typo here. So we have a bond price of 102. The cash payment here says 103 less the carrying value of 100,000. Our loss on retirement is 3,000. I think they mean 102, and the loss is 2,000. We'll see as we go on into the example. So our cash decreases 102,000. Our bonds payable decreases to zero because we are recognizing the payout, and then the loss on the bond is the 2,000. To see it more clearly, our bonds payable goes down 100,000. The loss on the bond of retirement is the 2,000 because at the time of retirement we had to pay out 102,000. Contingent liabilities, another type of liability that is dependent on something happening. Contingent liabilities are potential liabilities that arise from past transactions or events, but their ultimate resolution depends, or in other words, is contingent on a future event. Normally, these things are talking about legal fees and legal matters that still have to be paid. Could be other things, but generally speaking, most of the time, I believe it would be legal issues. It depends on how probable the future event is to determine how it gets recorded. So there's 3 different types. How likely is it? Is it probable it's going to get paid? Is it reasonably possible it could get paid? Or is it a remote thing that it's probably not even going to happen? Okay, so these are the 3 different circumstances. Can the amount be reasonably estimated? A reasonably estimated could be based on facts that have happened in similar situations in the past. For example, a wrongful death case. In the past, this certain kind of wrongful death case happened to be a $2 million settlement. So they could go back and look at different things like that to determine if it's reasonably estimated. Otherwise, there's no way to determine. It could be something it could be in the courts for a very long time, and they have no idea how much it could pay. Another example of being able to reasonably estimate is all of the interest that was paid during the housing debacle back in the 2007 to 2010 time period, where companies had to reimburse clients for too much interest being paid, or banks had to pay penalties to customers or to the government for overcharging clients. So those kinds of things might be able to be paid because they know how much interest was paid, right? In a legal event, it's based on something that happened in the past. Someone passed away, other things, liabilities, accidents can happen. So somebody takes somebody to court. It's likely that it's going to get paid. Can they reasonably estimate the amount of the liability? Sure, because they know how much it costs to either get something rebuilt, maybe fire was caused by some kind of irresponsibility, so the building had to be rebuilt. Those kinds of things can be reasonably estimated. Sometimes you just can't. So how likely is it how is it accounted for? All right, so look at this is kind of a decision tree effect on its side. So if it's probable, you go on to the next question. If it's likely to be paid, it's very probable that's going to be paid, and you can reasonably estimate how much is going to be paid, then you record the liability and the estimated loss. So here we have the legal expense of $27.50, and we're going to put it on an accounts payable. Accounts payable is a short term. All right, so we go to $27.50. It's probable that the liability is going to happen. We just don't know how much it could be. So what happens here is that you don't put anything in numbers. You don't put any numbers on your balance sheet, any numbers on your income statement. You're just going to describe it in a note. For example, this company says we are party to various legal actions. No claims have been determined, and we are reasonably likely to have a material adverse effect. But what this is saying is that we know we got this issue going on. It's in the courts right now. We just don't know how much we're going to have to pay. So we're letting you know this is happening with our company. We're in full disclosure here. We're just letting you know, letting the bankers know, hey, we got this going on. This might have to come out of our cash flow at some point. All right. How likely is the liability in this number 2? Reasonably possible. Same thing as probable and no. You're going to describe it in a statement on the note, in the notes on your financial statements. If it is a remote possibility that the liability will be created, you don't even have to mention it. It could be that a client has taken a company to court, but the lawyers already know, look, this is not going to happen. The people don't have the stuff that they need to prove their point. They just want to go through. They're going to have to pay all the bills for the court and everything, unless they have some kind of arrangement in their contract, whatever. But it's the possibility that we have to pay this is very remote. Okay, so you don't even have to mention it. So keep these 3 likelihoods in mind when you're doing your homework. Ratios. How we love to talk about ratios. So 2 financial ratios are commonly used to assess a company's ability to generate resources to pay future amounts owed. So the first one, we have our debt to assets ratio. And then we have our times interest earned ratio. So the debt to assets ratio is simply your total liabilities divided by your total assets. Please note, this does not include your shareholders' equity. That's completely separate from your liabilities and assets. So your total liabilities divided by your assets is your debt to asset ratio. You want this to be a low number. Okay, you want your total liabilities to be less than your total assets. And then your times interest earned ratio is your net income plus your interest expense plus your income tax expense divided by your interest expense. In the times interest earned ratio, the numerator of the times interest earned ratio contains net income plus interest expense plus income tax expense. We divide the numerator by the interest expense. The times interest earned tells us whether sufficient resources are generated to cover these other costs. The higher the number, the better the interest coverage. So what this saying is, if our net income plus the interest expense plus the tax expense, so essentially they're taking their net income and adding back the interest that has been taken out and then dividing it by the interest expense. So in other words, gross income divided by your interest expense. But they want to spell it out here in case there's other parts to the problem. At the end of a recent fiscal year, General Mills reported $222.2 million of total liabilities and $30.11 million of total assets. The debt to assets ratio is going to be your total liability, the 22,200, divided by your assets, the 30,110, equals 70.737. So the ratio, this ratio implies that creditors have provided financing for more than 2/3 of the assets of General Mills. What that's saying is we may have $30 million of assets on the books, but we owe still on most of it. So if we have $22 million in debt, but we only have $30 million in assets, we still are, this number is still a little bit high, but at least your liabilities are lower than your assets. But depending on the kind of market you're in will depend on whether this is a good ratio or not. All right. In the times interest earned ratio, General Mills reported net income of 1.76. The interest expense was $520 million. The income tax expense was $370 million. So they calculate the times interest earned for 2019. You're adding the interest and the taxes back to the net income. You're dividing it by the tax, so you'll see that these two numbers are the same, 5.1 times. The ratio means that this company generated $5.10 of income before costs of financing and taxes for each dollar of interest expense. Reaching this level of interest coverage was important to GM because its long-term debt note reported that the loan covenants required a minimum ratio of 2.5. In other words, $2.50 or 2.25 times. Straight line method of amortization. Getting back to our bonds here. All right. The bond premium or the discount decreases each year until it's completely eliminated from the bond's maturity date. This process is called the amortization of the bond premium or the discount, and it's usually done on a straight line method. So in this example, when we had this premium of the $72.60 and what is due on December 31st of 2024 is the $100,000. Under the straight line method, this $72.60 is spread evenly as a reduction in interest expense over the 4 years. So the $72.60 divided by 4 is $18.15 per year. So remember, the stated interest rate was 6%. So the interest for $100,000, which was the face value of the bond, is $6,000. Because the investors gave an additional $18.15, their interest expense, the company's interest expense, is lower at $41.85. So what this is saying is that the investors were willing to pay a little bit more to still get that interest payable that's paid at the end of every year. So that's why their stated rate, even though the bond is stated at 6%, their interest expense, or what they might get, the interest expense is going to be less. So you're going to take your cash that you paid out at the end of the year. You're going to decrease that. You're going to decrease the bonds payable. Remember our initial transaction, we got $107,000, so we had to record $100,000 in the bond, and the $7,000 in the premium. Okay, so then that $1,815 is going to your reduces your interest expense to $41.85 for each year. So your interest expense is increased. Your premium on the payable is decreased because you're reducing that $7,260, and then you're paying out the cash of $6,000. So the cash that's going out the door is still the 6% interest that they agreed to on the face value of the bond. Okay, so each year the bond holders get the $6,000 in interest. However, the company only has to recognize the $41.85 for the interest expense each year. So as each year the premium on the bond payable decreases to zero, and then when the bond matures, they're paying out just the $100,000. All right. So you'll notice that the carrying value of the bonds actually goes from the 107 down to 100. So when the premium is gone, then all that's left is the face value of the bonds. This is made pretty simple because the bond was issued on the first of the year. So that's simple straight line method. So let's recall the discounted bond. So the annual amortization on the discount is the same method, the 6624 divided by 4. However, the amortization of the discount actually increases the interest expense. So we're sending out our $6,000, and we are increasing the discount, and our interest expense increases to $76.56. Now this makes sense that the interest expense is going to increase because these are the skeptics that didn't want to put in the full price. So what's happening here is the discount has to be amortized. It has to go somewhere. So because the company was willing to take less than the face value, that meant that they are going to have more interest paid because they still have to pay out the stated interest rate on the bond, which was still the 6% of the $100,000. Whatever's on the face value of that bond is what gets paid out. The money actually collected is what determines the premium or the discount. All right, so here's your interest expense of $76.56 rather than just the $6,000. And then you're decreasing that discount, which remember is a debit balance. So here it's a credit balance, so it's actually going down. And then your cash is the same, $6,000 going out. So here it is again, the straight line method. Again, it's simplified because the date that it started was on 1/1. And then the same result at the end. Once your discount is amortized, then the face value of the bonds comes back up, in this case, $200,000. When we're talking about the premium, we're bringing down the face value. When we're talking about a discount, we're bringing up the face value. So the effective interest rate on the bond. Some of you may have heard the effective rate on your income taxes. So on your income taxes, those of you who have had the pleasure of doing your own, you will see that you report your wages, and then you have this little thing called standard deduction. And normally, if you don't own a house, everyone nowadays is using the standard deduction because itemized deductions have to equal a certain amount before they can be used. So a lot of people that used to itemize are now just using the standard deduction because of the way they've made changes in the last few years. But anyway, so if you are in a 10% tax bracket and your wages are $1,000 for the year, you're not paying 10% of the 1,000. You're paying 10% of the 1,000 less the standard deductible. Then you're getting, let's say your standard deductible is 100. So then your 1,000 less your 100 is $900. So even though you're in a 10% tax bracket, your effective tax rate could be something different. So let's take a look. The effective interest method of amortization is considered a conceptually superior method of accounting for bonds because it correctly calculates annual interest expense by multiplying the true cost of borrowing times the amount of money actually owed to investors. When General Mills adds the 7260 premium to the 100,000 face value, it reports a carrying value of the 107,260. On January 2021, the proceeds indicate the market interest rate was 4%. So the interest expense equals the carrying value times the market rate times n over 12. So in this case, for the year, the interest expense is $42.90. You have your 107,260 times 4% times 1. 12 over 12 is 1 year to come up with the $42.90. So the present value of $100,000 paid 4 years from now, the present value of $6,000, 6% stated interest rate paid once a year for 4 years. Then you have the bond price. So the market interest rates could be the 4, the 6, and the 8. Let's see how it changes the transaction. You have your cash interest of $6,000, your effective interest of $42.90. So your amortization of the premium is $17.10. $6,000 is what goes out the door. Since we've calculated this based on this effective interest method of the amortization, so we have the cash interest less the effective interest, which gives us that amortization, the $17.10, and then we recognize the interest expense. Interest expense, the $42.90. The premium on the bonds goes down, the $17.10, but still our $6,000 is paid out because that's the face value. So this is based on market rates. So this is the cash that was paid, never changes, but the interest expense changes based on the market rate each year. And then the difference is what is amortized. And then it's subtracted from the carrying value, again, taking it down, the bonds payable to the face value or the carrying value. All right, look at these numbers, they're different. Interest expense decreases and premium amortization increases each period. Cash interest is unchanged, which is this, the $6,000. right? So here is the discount. The market rate at the time was 8%. So that's how they came up with the 7470. The 93 times the 93 times the 8% times 12 over 12 or 1 year was the 7470. Same thing. 7470, your discount's being decreased, your same cash payment is made. Again, you have your 6,000 each each accounting cycle. Your expense increases every year, so it's different every year, just depends on the market rate. All right, same thing. The bonds payable equals the carrying value after all of the discount has been amortized. Both interest expense and discount amortization increase each period, and the cash interest is unchanged. And another method, simplified method. This is a face amount less the discount or face amount plus the premium. So here we have the premium method, the face value, and the discount. So we have the bond premium at the 4%. The interest expense or the bond discount. Notes payable. Interest. An installment note requires the borrower to pay interest and principal to the lender over the note's life to maturity. In effect, the borrower makes an interest and principal payment each period, resulting in no liability for interest or principal after the final periodic payment. So, if you've had debt already, you already know that a lot of interest comes at the beginning of the note. And that's because we haven't paid any principal down yet. So let's say we have a $100,000 note at 6%. The interest per year for the first year or for the first period is 6,000. Let's say the periods are monthly, so it's 6,000 divided by 12, and so on. However, every time we make a payment, our principal goes down. So we're taking the interest rate times the new principal to come up with the interest for the second year. Okay, so the beginning note starts at 60,000, comes down to 12,000 in year 6. The interest rate is 8%. So this is a simple interest method. You're just taking your 60 times 8 and your beginning note payable every year at the beginning of the year times the interest. So the interest is 17,874. Notice how it goes down because the principal is going down. And then your principal, your beginning note, your interest expense, and this is how much is paid in principal during the year. So the first year, we are interest expense. We're taking down our note by the 8,000, and in other words, we're paying down some of the principal of the note. In total cash, we've paid out $12,979. Year 2, the interest expense, the note payable, our cash outlay is the $12,979. So let's notice one thing. The interest expense here is 48. The notes payable is 8179. The cash out is 12,979. If you have a car payment, you know that you have the same car payment, let's say $500 every month until it's paid off. That $500 gets split into two different accounts. Some of it's interest, some of it's the principal on the loan. So in year one, you're paying interest of 48, paying down the note by the 8179, so your payment is 12,979. In year two, your interest is a little bit less and more of your principal is being paid down. But notice here, the same cash is being paid out. This will happen until the debt is fully paid. So here is when we don't have January 1st dates, which rarely happens because banks are closed on the 1st. So in September, they receive loan proceeds and establish the liability. They record the cash and they record the note. September, October, November, December, they owe for 4 months of interest. So they've calculated the interest and put it in interest payable for the $1,600. They're recording the first installment payment. Right? The journal entries for the installment payment differs from a fiscal year end. So they receive the loan proceeds on September 1st, 2018. Again, the cash is increased, the payable is increased. So at December 31st, you accrue the interest for the 4 months. On August 31st, 2022, the following year, you're going to record the interest. Let's say the interest is the interest and premium, interest and principal payment is only paid once a year. So that's the point of this process. So the first year, nothing was paid, only the interest was accrued. The next year comes along and they have to make the payment. So they're going to book the rest of the interest for that yearly payment. And then on August 31st, the day before the year after the 1 year point at when this note was created, you're going to have that $4,800, your $81.79 principal payment for the $12,979. Generally, payments are made monthly, but this particular example is showing you how interest is accrued when we have different time periods. So when I say clean and it starts at January 1st, you divide it by 12, that's clean. This is the way it's done when loans happen during the year. Okay, and again, this example, there's only one payment, one annual payment for each year until it's paid off after the 6 years. All right, this concludes the liability portion and concludes this chapter. There are some things that I got mixed up. I'm going to try and edit this video so you shouldn't get confused. However, as always, if you are confused about anything, please send me a text message. I'll be glad to help. We are in our last week. I hope you do well, and I'll talk to you soon.